Line title: The hidden banking trick that could control Bitcoin. What if I told you that Bitcoin, the asset designed to remove banks from the equation, is now being influenced by the very institutions it was built to avoid? Not through hacking, not through banning it, not through conspiracy, but through something far more ordinary: balance sheets. Let me explain. Imagine a 29-year-old software engineer in Chicago. She makes $92,000 a year. After federal taxes, state taxes, Social Security, Medicare, and health insurance, she brings home roughly $5,300 a month. Her rent, $2,100. Payment, $480. Student loans, $420. Insurance, utilities, subscriptions, $600. Groceries, $500. Eating out, travel, fun, gym, social life, another $700. She's left with maybe $500 to $600 in breathing room. She invests a little in her $400 in wonk. She buys some index funds, and occasionally, when the headlines get loud, she buys Bitcoin. She believes Bitcoin is separate from the system, independent, decentralized, outside of Wall Street. But here's the uncomfortable part. The price she pays for Bitcoin may already be shaped by the banking system she thinks she's escaping. To understand the hidden banking trick, we have to zoom out. For years, Bitcoin traded mostly on crypto-native exchanges, retail investors, early adopters, tech enthusiasts. Volatile, yes, but largely driven by supply and demand from individuals and crypto funds. Then something changed. In 2024, the US approved spot Bitcoin ETFs like iShares Bitcoin Trust from BlackRock, Fidelity Wise Origin Bitcoin Fund from Fidelity Investments, and similar products from firms like Invesco. On the surface, this looked like validation, institutional acceptance, mainstream adoption, and it was, but it also quietly connected Bitcoin to the traditional banking system in a new way. Because these ETFs are not magic, they operate inside the existing financial plumbing. Because these ETFs are not magic. Here's where the trick begins. When you buy a Bitcoin ETF in your brokerage account, you don't actually buy Bitcoin directly. You buy shares of a fund. That fund holds Bitcoin on your behalf. The fund has custodians. The custodians are banks. The liquidity providers are large financial institutions. The authorized participants who create and redeem ETF shares are major banks and trading firms. This means that a large portion of Bitcoin demand now flows through institutions that can borrow, lend, hedge, short, and rebalance using complex financial tools. Bitcoin didn't change, but the structure around it did. Let's simplify it with math. Imagine retail investors collectively buy $1 billion worth of Bitcoin in a week. In the old system, that demand hit exchanges directly. Limited supply. Price rises sharply. In the new system, much of that demand flows through ETF structures. Large banks and authorized participants can create ETF shares, hedge exposure with futures contracts, manage inventory, and even short against inflows to control volatility. They can delay spot purchases, they can use derivatives, they can arbitrage price gaps. It's not illegal, it's not evil, it's simply how modern financial markets function, but the effect is subtle. Banks don't need to attack Bitcoin to influence its price, they just need to manage liquidity, and whoever controls liquidity often controls price stability. Now let's bring this back to our software engineer in Chicago. She hears that institutions are buying Bitcoin. She feels safer investing because BlackRock is involved. It feels legitimate. So she allocates $10,000. But what she doesn't see is this. If banks can create synthetic exposure through futures, options, and ETF share creation, they can absorb buying pressure in ways that reduce dramatic price spikes. They can also unwind exposure during stress periods, increasing downside pressure. In simple terms, the more financialized Bitcoin becomes, the more it behaves like other institutional assets. And institutional assets respond heavily to one thing: interest rates. Consider this: when the Federal Reserve raises rates, borrowing costs increase, liquidity tightens, banks become cautious, risk assets decline. Bitcoin used to be marketed as digital gold, a hedge against the system. But during recent tightening cycles, Bitcoin fell alongside tech stocks. Why? Because once large institutions hold Bitcoin, they treat it like a risk asset. If they need liquidity, they sell what's liquid. Bitcoin ETFs are liquid. So Bitcoin becomes part of the liquidity cycle, not separate from it. Let's talk psychology. Why do people ignore this? Because decentralization is emotionally appealing. It feels empowering. They ask who really provides liquidity. They look at who manages custody. They study who creates and redeems ETF shares. They understand how monetary policy flows through markets. They don't panic during volatility because they expect cycles. Bitcoin may still represent digital scarcity, but price behavior is shaped by liquidity. And liquidity is influenced by banks. This does not mean banks secretly control Bitcoin, but it does mean they influence how easily money flows in and out of it. And when liquidity tightens across the economy, even decentralized assets can experience very centralized selling pressure. Most investors focus on headlines, but very few study the plumbing behind how trades are actually settled. The real influence rarely happens in dramatic announcements. It happens quietly inside balance sheets and risk models. When institutions allocate capital, they follow risk frameworks that adjust exposure automatically when conditions change. Volatility rises or credit markets tighten, those frameworks may reduce Bitcoin exposure without emotion. That reduction is not personal, it is procedural, and procedures operate faster than retail sentiment. This is why Bitcoin now often moves in sync with technology stocks during major macroeconomic shifts. The asset did not change its code, but its ownership structure changed significantly, and ownership structure influences behavior far more than most individual investors realize. When large funds dominate ownership, price discovery becomes less about emotion and more about structured capital allocation models. Capital moves according to models, and models respond directly to interest rates, credit spreads, and volatility metrics. When rates rise, discounted future value falls, and risk assets often reprice lower almost automatically. Bitcoin is increasingly included in those same risk buckets that portfolio managers adjust during tightening cycles. That inclusion brings legitimacy, but it also brings correlation with broader financial markets. Correlation does not destroy Bitcoin's fundamentals, but it does change short-term price behavior dramatically. Many retail investors mistake short-term price swings for failure of the underlying technology. But markets can be liquid and cyclical even when technology remains unchanged. The misunderstanding comes from confusing decentralization of code with decentralization of price formation. Code may be decentralized, but price emerges from the structure of global capital flows. And global capital flows are heavily influenced by central banks and large commercial banking institutions. When central banks expand balance sheets, liquidity increases and risk assets often rise together. When they contract balance sheets, liquidity tightens and speculative assets frequently fall in response. Bitcoin is now large enough that these macro liquidity waves reach it consistently. It no longer exists in a completely isolated financial corner of the internet. Instead, it sits inside portfolios that must answer to risk committees and quarterly reporting standards. Those committees are not ideological, they are mathematical and procedural by design. And mathematics does not care about decentralization narratives or online enthusiasm. It responds to inputs like inflation, rates, volatility, and credit expansion. When those inputs shift, portfolio exposure shifts with them, including Bitcoin allocations. This shift does not require coordination or conspiracy, it simply reflects how modern portfolio management systems are designed to function. Large institutions reduce risk when volatility spikes, even if the long-term thesis remains intact. That automatic de-risking can create sharp price swings that feel emotional, even though they are systematic. Retail investors often interpret those swings as panic, when they may actually be model-driven reallocations. The emotional narrative and the structural explanation can look identical on a price chart. But understanding the structure changes how you react when markets move quickly. Instead of assuming manipulation, you begin to analyze liquidity conditions and credit expansion trends. You start watching central bank balance sheets as closely as you watch price charts. Because liquidity expansion often lifts all risk assets, not just a single cryptocurrency. And liquidity contraction can pressure everything simultaneously, regardless of narrative strength. This is why Bitcoin sometimes falls on days when there is no negative news specific to the network itself. The selling may originate from margin calls, risk parity adjustments, or portfolio-wide de-leveraging decisions. In those moments, Bitcoin is treated as a liquid asset that can quickly generate cash. Liquidity is valuable precisely because it can be sold without excessive friction. And Bitcoin ETFs have made that liquidity more accessible to large institutional players. Accessibility increases demand during expansions, but it also increases selling pressure during contractions. That dual effect is rarely discussed when institutional adoption is celebrated in headlines. Most headlines focus on inflows, but very few analyze outflow mechanics during stress periods. Outflows can accelerate when risk models trigger automatic reductions across diversified portfolios, and when multiple institutions act simultaneously, price volatility can amplify beyond retail expectations. From the outside, it can look like sudden manipulation, but internally it is often synchronized risk management. Risk systems across institutions often rely on similar volatility thresholds and capital preservation rules. When those thresholds are crossed, exposure reductions can happen across multiple funds at once. That simultaneous action can magnify price moves, even if no single institution intends to move the market. This is a structural outcome of financial integration, not necessarily a coordinated strategy. As Bitcoin becomes embedded in retirement accounts, pension funds, and asset allocation models, its behavior evolves. Assets rarely remain unchanged once they are absorbed into institutional capital frameworks. History shows that integration often reduces extremes but increases correlation with broader markets. Reduced extremes may sound comforting, but correlation introduces a different type of systemic exposure. When everything responds to the same liquidity cycle, diversification can quietly weaken. Many investors believe they are diversified, but their assets may all depend on the same liquidity environment.